Inflation. It's a term we hear thrown around often, especially in today's economy. But what does it really mean? When people talk about inflation, they're usually referring to the general increase in prices across a wide array of goods and services, what we might call a big basket of essentials. Now, this basket is something we all interact with every day. Think about it. Groceries, gas, rent, and utilities. These are the things that make up the backbone of our daily expenses. And the truth is, this basket is a lot more expensive than it used to be. To put it into perspective, since the beginning of 2020, the overall cost of this basket in the US has shot up by roughly 20%. That's right, a staggering 20% increase in just a few short years. It's no wonder people are frustrated and feeling the pinch every time they reach for their wallets. And although the rate of inflation is beginning to slow, with experts predicting it could dip to around 2.5% to 3% by the end of this year, the damage has already been done. The higher cost of living is a reality that's not going away anytime soon, and that's why so many voters are still furious, even as inflation begins to cool. Now, imagine for a moment the US economy as a mighty ship navigating through turbulent waters. The Federal Reserve, acting as the ship's captain, has been steering us through some of the roughest seas we've seen in decades. But here's the catch. The ship has taken on some serious damage, and one of the most critical components, the Federal Reserve's balance sheet, is starting to buckle under pressure. This is no ordinary problem. We're talking about a monumental $1 trillion dilemma. Yes, trillion with a T. This isn't just a number. It's a ticking time bomb that could potentially push the economy into a recession if not handled correctly. But don't worry, there's hope on the horizon. Professor Steve Hanke, a seasoned economist, offers a strategy that might just save us from being thrown into economic chaos. Today, we're going to break down what's really happening with the Federal Reserve's balance sheet, why it matters, and how you can protect your investments during these uncertain times. To understand the gravity of the situation, we first need to look at the Federal Reserve's actions over the past few years. In response to the economic fallout from the COVID-19 pandemic, the Fed began buying massive amounts of securities. The idea was simple: inject liquidity into the economy to keep it afloat and prevent a financial meltdown. And for a while, it worked. The economy was stabilized, markets recovered, and a crisis was averted. But there was a catch. The securities the Fed purchased have since depreciated in value, leading to a staggering $1 trillion in unrealized losses. Now, these losses aren't just theoretical numbers on a balance sheet. They're starting to become very real, very fast. According to recent reports, the Fed has already recorded over $100 billion in actual losses in 2023 alone, and this could continue well into the next decade. Imagine a financial black hole slowly pulling the Federal Reserve deeper and deeper into trouble. That's the situation we're facing. But why does this matter to you and me? Well, when the Federal Reserve turns a profit, that money is transferred to the US government, helping to fund public expenditures. However, when the Fed incurs losses, that money flow dries up. No profits mean no transfer to the Treasury, which could result in larger government deficits. Essentially, it's like losing a major source of income. Something's got to give. The government might need to borrow more, cut spending, or even raise taxes to make up the difference. This situation has far-reaching implications for the economy, and by extension, your investments. Let's take a moment to zoom out and talk about a fundamental concept in economics: the money supply. The year-over-year growth rate of the money supply, particularly the measure known as M2, is crucial. M2 includes cash, checking deposits, and other near-money assets, making it a key indicator of economic health. To hit the Fed's inflation target of 2%, the money supply should be growing at around 5% to 6% annually. But here's the kicker. The money supply has not only contracted since July 2022, but it's also growing at a rate far below what's needed to sustain that 2% inflation target. In simpler terms, the economy is losing steam. And while a slowdown in inflation might sound like good news, the reality is more complicated. This contraction in the money supply could be a warning sign of a potential economic downturn or even a recession. It's like a car speeding down the highway that suddenly slams on the brakes. Sure, the car slows down, but there's also a risk of skidding out of control, or worse, crashing. The same principle applies to the economy. So, why is this $1 trillion dilemma such a big deal? The problem lies in the Fed's limited options to address these losses. Unlike a regular bank, the Federal Reserve can't just go bankrupt. However, printing more money to cover its losses could reignite inflation, which is the last thing anyone wants after the soaring prices we've seen over the past few years. On the other hand, tightening monetary policy by raising interest rates to curb inflation could further contract the money supply, increasing the risk of a recession. It's a delicate balancing act with no easy solutions. This brings us to the critical question: what can you do as an investor to navigate these turbulent waters? According to Professor Steve Hanke, the answer lies in controlling the money supply. If the Federal Reserve can manage the money supply effectively, it can control inflation, which in turn affects interest rates. But what does this mean for your investments? Let's talk about bonds. Professor Hanke suggests that long-term interest rates in the United States are likely to come down as inflation decreases. When interest rates fall, the price of bonds rises due to the inverse relationship between bond prices and yields. This means that investing in long-term U.S. Treasury bonds could be a smart move right now. Not only would you earn a decent yield, but you could also see a capital gain as bond prices increase, a win-win for investors looking for safety and returns in these uncertain times. But what about the stock market? Well, caution is the name of the game. The stock market has been riding high on the back of massive liquidity injections over the past few years. However, with the money supply contracting and the Fed's losses mounting, the market could be in for a bumpy ride. This doesn't mean you should pull out of stocks entirely, but it does mean you should consider diversifying your portfolio. Bonds, as we mentioned earlier, are a safer bet in this environment. Precious metals like gold, which tend to perform well during times of economic uncertainty, might also be worth considering. Another important piece of Hanke's strategy is to keep a close eye on the money supply. Understanding the trajectory of M2 can give you a significant edge as an investor. If the money supply starts to increase again, it could signal a return of inflationary pressures, meaning you might want to adjust your portfolio accordingly. On the other hand, if the contraction continues, staying in safer assets like bonds might be your best course of action. In conclusion, the Federal Reserve's $1 trillion dilemma isn't just a headline. It's a serious issue with the potential to impact the entire economy and your financial future. But by following Professor Hanke's advice, monitoring the money supply, considering bonds as a safe investment, and staying diversified, you can position yourself to weather the storm. Investing is about more than just riding the highs. It's about protecting your wealth during the lows and making strategic moves based on sound economic principles. As we stand on the brink of what could be a significant economic shift, it's more important than ever to stay informed, stay cautious, and make decisions that align with your long-term financial goals. Remember, knowledge is your greatest ally in the world of investing. By staying vigilant and proactive, you can navigate these uncertain times and come out on the other side stronger than ever. If you're finding this content helpful, don't forget to subscribe to Economic Hero for more insights on how to protect and grow your wealth in today's volatile economy. And with that, we wrap up today's discussion. If you enjoyed this video, be sure to hit the like button and subscribe to Economic Hero for more content that helps you take control of your financial future. Thanks for watching, and we'll see you in the next video.